After studying this module, you shall be able to learn the meaning, concept, and aims of budgetary control, know the characteristics of a budgetary control system, explain the advantages of a budgetary control system, elaborate prerequisites of a successful budgetary control, identify the steps required in the installation of a budgetary control system, and understand the various control ratios.
Just as budget is a very significant aspect of our individual lives, similarly, it is equally significant for any corporate as well. We know that budget is a plan that shows how the resources are to be acquired and used over a specified period of time. While the operations are in progress, budgets serve as a basis for comparing actuals with the budgeted estimates, thereby facilitating control. The use of budget as a means of controlling the various activities is called budgetary control.
Budgetary control is a part of overall management control of the organization. It is the essential tool of management for controlling costs and maximizing profits. Let us look at some of the definitions on budgetary control. Number 1. As per the Institute of Management Accountants, London, budgetary control means establishment of budgets relating to the responsibilities of executives, to the requirements of a policy, and the continuous comparison of the actual with the budgeted results, either to secure by individual action the objective of that policy or to provide a basis for its revision. Number 2. In the words of J. A. Scott, it is a system of management control and accounting in which all the operations are forecasted and planned so far as possible ahead and the actual results compared with the forecasted and planned ones. Based on the definitions, it is evident that the budgetary control involves establishment of budgets, continuous comparison of actual performance with budgets, finding out discrepancies, fixing the responsibilities, taking corrective measures, and revising the budgets in the wake of changes in circumstances. A budget is the plan of estimated expenses and or revenues associated with the operations of various departments of the organization. Budgeting may be said to be the process of preparing budgets, while budgetary control embraces all this and, in addition, includes the science of devising the budgets themselves and using such budgets by the management for effective overall control over the operations of the organization. The objectives of budgetary control are: number 1, definition of goals, which is to portray in clear-cut terms the overall aims of the organization and breaking them down into target goals of each unit. 2. Defining responsibilities, that is, to clearly specify the responsibilities of each person so that everybody knows what is expected out of them and how will they be evaluated. 3. Optimum use of resources, meaning to use the human, financial, and material resources in the best possible manner and reducing wastages. Number 4. Coordination and cooperation, which means to integrate different units and departments so that they work with harmony in a unified manner. Number 5. Proper execution, that is, to ensure that all activities are proceeding in the manner envisaged in the budget. 6. Ease in comparison, which is to compare the actual performance against the budget and draw attention to the deviations observed. 7. Proper remedial measures, implying taking proper measures in case deviations are noticed to prevent discrepancies in future. 8. Revision, that is, to revise the budget in the light of changed circumstances. A budgetary control system has the following characteristics. Number 1. Establishment of budgets. Budgets are prepared for each department and then they are presented to the management for approval. 2. Coordination among departments. The plans of various departments are coordinated and finally integrated into the master budget. 3. Comparison. Under budgetary control, the actual performance is compared with the budgetary estimates on a continuous basis to discover the variations and to fix responsibilities. 4. Revision. The budgets are revised in the light of changes in the conditions and circumstances. The advantages of budgetary control are numerous. It prevents the occurrence of the deviations from the pre-planned path through the media of observation, research, planning, control, and decision making, and thus helps in the performance of future activities in an orderly manner. Some of the advantages are: number 1, efficiency and economy. Budgetary control reveals the faults in the operations, weaknesses in the organizational structure, and minimizes wasteful spending. 2. Fixation of responsibilities. Budgetary control prevents buck passing and exposes those who are at the fault or responsible for deviations. 3. Coordination. It coordinates the production, marketing, financial, administrative, and other dimensions and forces them to work in totality rather than in isolation and operate as a group in harmony. Number 4. Predetermination of financing. Because the organization has a blueprint of activities to be undertaken in the coming period, funds and finances can be arranged well in advance, preventing the financial crisis. 5. Management by exception. Budgetary control exposes the deviations and only variances and discrepancies are reported to the superiors. This enables them to concentrate on these issues seriously, enabling management by exception. 6. Forerunner of standard costing. A budgetary control makes available budgeted figures which can be used as a benchmark for variance analysis, paving way for the adoption of standard costing principle in the organization. 7. Objectivity in evaluation. Since everyone's performance is assessed on the basis of preset criteria, assessment is objective without any bias. For an effective system of budgetary control, the presence of following elements is necessary. Number 1, the budgetary control system should have the full support of top level management as well as the cooperation of all the employees. 2. There should be well planned organizational setup in which responsibility and authority of each one should be clearly demarcated. 3. The accounting system should provide accurate and timely information. Number 4. There should be proper system of communication and reporting, and all the participants of the organization must be involved in budget setting process. 5. There should be an efficient system of feedback which reports variances fairly and promptly. 6. The staff should be highly motivated and have faith in the budgetary control system. 7. And last, the budget should be used as a coordinating device rather than a control device. Let us now move on to discuss the budgetary control process. The method by which a budget is prepared differs from the organization to organization. While some organizations may have well organized, well documented procedures, others may not have any formal procedure, and so in their case, budgeting process proceeds in a haphazard and disorganized manner. But since budgeting is an important planned exercise, it is suggested that it should be carried out in a systematic manner to avoid the conflicts and frustration at later stage. Differences in the management styles, organizational objectives, size of the organization, nature of business, and similar factors have bearing on the procedures to be adopted by an organization in the budgeting process. Nevertheless, some of the common steps are: number one, specification and communication of organizational objectives; 2, preparing well defined organizational chart; number 3, consideration of certain key issues; number 4, initial preparation of budget components; 5, negotiation; 6, coordination and review; 7, final approval and distribution; 8, implementing the budget plan; 9, revision. The first step is specification and communication of organizational objectives. A budget is a medium through which an organization's objectives and policies are reflected. The budgeting exercise starts in the light of these objectives plus policies and guidelines issued by top level management to govern budget preparation. Detailed information and guidance is given on matters such as projected general economic conditions, allowances to be made for price increase and wage increases, changes in the scale of operation, and so on. Further instructions are issued as to what information is required from each responsibility center for the budget and how this information is to be recorded in the budget form. In the absence of statements to the contrary, it is assumed that factors affecting operations in the budget year will be similar to those in the current year. The second step is preparing well-defined organizational chart. An organization should have a well-defined organizational chart depicting the hierarchical position of each executive in the organization and his functional responsibility. Such a chart will clearly show the lines of authority, the authority delegated, and relative position of each in relation to the other. The next step is the consideration of certain key issues. Principal budget factor or critical success factor. Every organization has certain critical success factors or key factors that can influence the activities of an undertaking and can limit the volume of its output. They impact the profitability of the organization. Critical success factors should be specified: raw material, a specific type of skilled labor, floor space, cash resources, etc. These limiting factors may shift from time to time due to external and internal circumstances. So, care must be taken for their identification and the ways of overcoming key factors. In majority of the organizations, the most critical factor is consumer demand or expected level of reserves or sales. That is why sales budget is usually prepared first of all, followed by other related budgets. Budget centers. A budget center is the lowest unit in the organization for which detailed costs are budgeted separately from those of other budget centers. It is a center of organization for which separate budgets can be prepared and control can be exercised. The entire organization should be clearly divided into different sections as budget centers for enabling budgetary control and fixing responsibilities of departmental heads.
A budget period is a period for which the budget is prepared. This is the period for which forecasts can reasonably be made and estimates can be given. Budget period could be short range, medium range and long range. Short range budget may cover period of 3 months or 6 months or 12 months. Medium range budgets cover period more than 12 months and up to 2 years, while long range budget covers period which is more than 2 years. Capital expenditure budget and research and development budgets are examples of long range budgets. Sales budgets or income and expenditure budgets are examples of short range budgets. In preparing short range budgets, certain factors must be kept in mind, like budget period should have a term enough to complete production cycle of various products. In case of seasonal business, the budget period should cover one entire seasonal cycle. It should be long enough to provide adequate time to arrange funds for production and should coincide with financial accounting period to facilitate comparison of actuals with budgeted estimates. Budget committee is the body entrusted with the responsibility of overseeing the proper formulation and implementation of the budget. The budget involves the various functional activities and so the association of various functional managers is desirable. The budget committee is composed of all major functional heads and acts as a forum where communication, coordination and discussion among them is facilitated. The main function of the budget committee is to assist functional managers in preparation of budget, receive and review their budget estimates and recommend changes if any, resolve conflicts between departments on the budget matter, to prepare master budget on the basis of functional budgets, to compare budget with actual performance and recommend action to be taken on the basis of variance analysis and make recommendations for the budget manual.
Budget Manual. It is a document which contains standing instructions with respect to the procedures to be followed and the time schedules to be observed while making budgets. It acts as a guide in the hands of budget officers and all the functional heads and prevents the need of frequent instructions from the top level management. The budget manual provides instructions such as time limit for submission of preliminary forecasts, person to whom this has to be submitted, important items for each forecast, categorization of expenses, prescribed forms to make reports, listing the matters to be decided only with the approvals of the top level management, etc. The fourth step is the initial preparation of budget components. The budget guidelines prepared by top level management together with the sales plan are disseminated down through the successive levels in the organization. Managers at each level add more detail for the guidance of their subordinates. When the guidelines arrive at the lowest responsibility center, the concerned manager prepares the budget plans for the items falling within his sphere, keeping in mind the constraints specified in the guidelines. These estimates are made by him by combining specific analytical techniques with his judgment.
Negotiation. Negotiation between a superior and subordinate is a very crucial stage in budgeting process. If budget is too tight, it becomes unattainable and leads to frustration. On the other hand, if it is too loose, it leads to complacency. The budgetee and his superior, therefore, seek to arrive at a desirable middle path by means of slacks and cuts. The subordinates generally resort to slacks or padding, for example, overstating their budget cost or understate their budget requests to create a budgeted profit at the level that is easier to achieve. Budgetary slack provides protection against cost increase or revenue shortfalls due to unforeseen events, but it leads to budget cuts imposed by the superior, who is aware of slack, padding and other similar tactics of the subordinates. In order to address this issue, instead of resorting to an arbitrary cut, superiors should require a full explanation of why costs must be expected to increase. Subordinates, on their part, must justify increase in cost by explaining underlying causes such as cost inflation, need for better quality and so on. The end product of the negotiation process is an agreement which represents a commitment by each party, the budgetee and the superior. The nature of the commitment should be one of the three following types. 1. It may represent a ceiling. For example, not more than 10 lakhs should be spent for the employees. 2. It may represent a floor. For example, at least 10 lakhs should be spent for employee training. Third, it may represent a guide. For example, approximately rupees 10 lakhs should be spent for employee training.
The next step is coordination and review. The negotiation process is repeated successfully at higher levels of the organizational hierarchy up to the very top. Negotiations at higher levels result in changes in the detailed budget that have been agreed to at lower levels as well. As the individual budgets move up in the organizational's hierarchy, in the negotiations and review process, they are also examined in terms of the compatibility, that is, in relationship to one another, and potentiality, that is, whether in the overall interest of the company. If they are found out of balance, some of the underlying budgets or figures may be modified. Major unresolved issues are submitted to the budget committee. The next step is the final approval and distribution. Just prior to beginning of the budget year, the proposed budget is submitted to the top level management for approval. If the proper procedure is followed and there are no great surprises in the proposed budget, they are approved. The budgets are then communicated to the departments or responsible managers. Modifications incorporated in the final budget should be particularly made known to managers to seek their cooperation and support for the budget. Next step is implementing the budget plan. The final budget is presented to the managers concerned and adopted as the plan of operation for the forthcoming budget period. The various service units in the organizations are required to release the necessary materials, labor, facilities, finances, and other resources to carry out the budget. Next step is implementing the budget plan. The final budget is presented to the managers concerned and adopted as the plan of operation for the forthcoming budget period. The various service units in the organizations are required to release the necessary materials, labor, facilities, finances, and other resources to carry out the budget. Budget report is like a report card of a budget center. In this report, the actual figure and the budgeted figures are reported side by side to facilitate comparison and determine deviations or variations. In the report, both favorable and adverse variations should be reported with necessary comments or reasons. These reports form the basis of fixing the responsibility and taking corrective action. The budget report follows the principle of management by exception. Moving on, let us now discuss the budgetary control ratios. The management employs ratio analysis to know whether there are any deviations between the budgeted figures and the actual results. Control ratios are the effective tool in the hands of management to exercise an effective control over the budgeted results. These ratios are expressed in terms of percentages. If the ratio is more than 100%, it is treated as favorable, and if it is less than 100%, it is considered as adverse. The important budgetary control ratios used by the management are: number 1, activity ratios; 2, capacity ratios; 3, and last, efficiency ratios. Activity ratio. This ratio measures the level of activity attained by the firm over the specified period. Symbolically, activity ratio is equal to standard hours required for actual output divided by budgeted hours and multiplied by 100. Capacity ratio. This ratio measures the extent to which budgeted hours of activity have been actually used. Symbolically, capacity ratio is equal to actual hours worked divided by budgeted hours multiplied by 100. Efficiency ratio. This ratio measures the extent of efficiency attained in the production. Symbolically, efficiency ratio is equal to standard hours for actual production divided by actual hours worked multiplied by.
Let us now summarize what we have learned in this module. Budgetary control involves establishment of budgets, continuous comparison of actual performance with budgets, finding out discrepancies, fixing the responsibilities, taking corrective measures, and revising the budgets in the wake of change in the circumstances. The objectives of budgetary control are definition of goal, defining responsibilities, optimum use of resources, coordination and cooperation, proper execution, ease in comparison, and prompt remedial measures, revision, etc. The characteristics of a budgetary control system are: 1. Establishment of budgets; 2. Coordination amongst departments; 3. Comparison and revision. The advantage of budgetary control systems are efficiency and economy, fixation of responsibilities, coordination, predetermination of financing, management by exception, forerunner of standard costing, and objectivity in evaluation. The essentials of a successful budgetary control system are support of top-level management, well-planned organizational setup, proper accounting system, proper communication system, efficient system of feedback, highly motivated staff, and use of coordinating device rather than a control device. The budgetary control process consists of a series of steps. These are specification and communication of organizational objectives, preparing well-defined organizational chart, consideration of certain key issues like principal budget factors, budget center, budget period, budget commitment, budget committees and budget manual. Initial preparation of budget components, negotiation, coordination and review, final approval and distribution, implementing the budget plan, and the last step is revision. Budget report is like a report card of a budget center wherein the actual and budgeted figures are reported side by side to facilitate comparison and determination of deviations. The three types of budget ratios that we discussed in this module are activity ratio, capacity ratio and efficiency ratio.